And already then we said that. Cool. Hey everyone, I'm Yuval. I'm the co-founder and CEO of Digital Asset, the creators of Canton Network, which is a privacy enabling layer one. So what we're going to talk about is the opportunity around stable coins and just generally speaking, assets on chain once you unlock the ability to do compliant privacy. So that's me. Cool. So those of you who have been tracking Vitalik have been very active recently, and about a week or so ago, Ethereum announced that privacy is freedom, privacy is order, privacy is progress. And it's extremely exciting that the founder of Ethereum have come to that conclusion. At Digital Asset and Canton, we have written the white paper of Canton in 2015. And already then we said that in order to unlock assets on chain, privacy is a must have. And why is it a must have? If we look at the market in 2024, we had $25 trillion worth of stablecoin pair trading. But if we compare that just to the revenue, not actual volume, we're seeing $2.5 trillion of revenue potential. But the reality is that without privacy, right, we're not going to be able to achieve that potential. And really at Canton and Digital Asset, that's what we've been focusing. Institutions will not transact on chain unless privacy is enabled. So to us, public chains are failing today, institutions that want to come on chain. And we believe that privacy is a bug. It's not a feature. I think that it's important to understand that when it comes to Bitcoin, which is a specific and very unique asset class, that's where, the lack of privacy is allowing the asset to be transparent and not to have any hacks. But when it comes to real world assets, you don't need that kind of a feature. And as you see already, the assumption is that by 2028, most stable coins that we know today already will fail to reach adoption. And therefore, us as an industry, we need to focus on what are the features that are needed in order to allow large institutional players to transact on chain. So let's just think about some of the examples of why we need privacy. One of the exciting opportunities is to distribute payroll in real time. Maybe some of you here would enjoy everybody know how much you get paid and see when you get paid. Most people do not want their payroll to be known to the rest of the world. And for the most part, employers would not accept to show everyone what is their payroll. The other one is B2B payments. Again, if we're thinking about corporates today, when it comes to the crypto market, corporates maybe are okay crypto networks to show what they're doing. But if you start thinking about traditional corporations, they again would not be okay showing the entire world what they're transacting in real time. Think about a publicly traded company will not be comfortable with everyone seeing what they are transacting on chain in real time. Also, another great example is we're seeing treasury management. So a lot of corporations today are very interested to use stablecoins to manage their balance sheet more efficiently. And as a result of that, again, they will not be okay with everyone seeing how they manage their treasury. For those of you who've been in crypto, you probably know whale watchers. Whale watchers are X account that look at everything that is happening on chain. And every time a crypto asset moves, they put it on X, and then everybody sells before the asset was able to be liquidated on an exchange, right? We always see a lot of Bitcoins move to Binance, they move to OKX, they move to Coinbase, market sells ahead. Again, Those type of activities are things that large institutional players would not be okay with. And I think that if we solve for privacy, we can prevent these things from happening. And then just generally speaking, we will talk in a second. I think that what a lot of large banks and large scale institutions are very excited about is how to start moving to 24/7 financing. So for those of you who've been tracking, a lot of the traditional exchanges have been talking about moving to 24/7 trading. But the reality is that if you want to move to 24/7 trading, we need to be able to move margin 24/7. And again, if we want the large institutional players to participate in such activities, we need to be able to solve for privacy. Now, I think that in the last year, we started to hear a lot of layer ones talk about privacy. And it's extremely important to understand that privacy is very specific when we talk about it in Canton. For us, privacy has to be compliant with regulation. That means that you need to be able to share information on a need to know basis rather than to solve for anonymity. And what I mean by that is if a regulator comes to an exchange or a stablecoin issuer, they need to be able to make sure that said stablecoin issuer have complied with all KYC AML rules. A lot of times, what you will see, because most layer ones did not solve for privacy to begin with, they're hoping now that zero knowledge proof will be a patch that you can, slap on a layer one and voila, you have privacy. But the reality is zero knowledge proof is not compliant. It's a black box that doesn't allow the issuer or the regulator to actually see what is happening inside. And although it's a very exciting technology, my co-founder actually is one of the creators of zero knowledge proof. It's not compliant with regulations. And therefore, I think that that's an extremely important thing to understand the difference if you are a regulated financial institution. And as a result of that, as you can see, these type of regulated institution trusted Canton, we have over $6 trillion of assets already on chain. You will see more and more. A lot of people ask me, why don't you see this on RWA.xyz? What we're doing is we're asking some of our clients to actually start exposing the numbers. But again, that's one of the challenges with privacy. You can't just see everything that is happening on chain. So what you're going to see in the coming months is more assets becoming available on Canton, all the way from treasuries, equities, stablecoin, tokenized deposits, and many more. And what you're going to see is a lot of financing on chain, not just for crypto activity, but actually for traditional finance. And I think that the opportunity is huge. I mean, if you look at what we call eligible collateral in the world, there is about $260 trillion worth of assets. And currently, due to lack of mobility, meaning the inability to move these assets in real time efficiently, only 10% of these assets get used on a daily basis on average. So there are about $240 trillion worth of assets that we can bring on chain and use for better financing. About a month and a half ago, we did the first transaction where US Treasury were available natively on Canton. And I want to make sure everybody understands, not to mistaken it with tokenized US Treasury. This was not a wrapped US Treasury. This was an actual US Treasury held legally at the DTCC, which is the legal record of US Treasury in the US. And it was used to do a repo transaction, effectively a financing transaction over the weekend, where traditionally speaking, you couldn't be doing those type of financing activities. This is just a list of some of the traditional finance institutions that are already using Canton today. You can see there's different kinds of use cases. But really what we are very excited is that, the network is already number 5 from on-chain fees. We've had 10x user growth just in the last month. And we have now 400 validators running on the network. And, we're very excited that the coin of the network will get listed roughly within the next few weeks. But we're very excited to actually be working here in Asia. We're hoping to expose more and more of the clients in the next coming weeks and months. And we want people to come and build together with us. And I think where I will end is, I think that when you look at a lot of layer ones, it is really the miners or the validators that earn most of the tokenomics, not most, all of the tokenomics. When we built Canton, we realized that we need to make sure that we align our incentives with those that build on the network. So in Canton, the tokenomics actually get distributed between not only the miners, we call them super validators, but actually most of the tokenomics go to the app providers, those that build the apps, do the hard work of trying to get clients, develop new business models, so that the applications on Canton actually earn most of the tokenomics, and also the users. And that have led to really nice user growth, app growth. And we would be very excited to partner with everyone here in the room that wants to come and build with us on Canton. So with that, I'll finish by saying thank you very much for taking the time.
Thanks everyone for being here. We have a great panel. Today we're talking about money and assets going digital in ways that make payments move faster and safer. I'm going to talk about what's real, what's happening now, what regulations there are that are unlocking that, what regulations we'd like to see, and what's next. So before we get started, I just would hope for us to go down the line, introduce yourselves, and then we can get started.
Sure. So hi, everybody. My name is Sam Tenkate. I'm part of State Street Investment Management, formerly known as State Street Global Advisors, or SSGA. And I lead I'm the head of digital asset strategy. Prior to that, I spent some time on the bank side of State Street. And then prior to that, I was in a management consulting with Promontory Financial Group, focused on helping fintechs and other digital asset players come into the regulatory perimeter.
Good day, everyone. My name is Scott Lucas. I'm the head of markets digital assets at JP Morgan. So that's within the sort of structure of JP Morgan, the sort of trading bit of the commercial investment bank, sort of setting the strategy and figuring out how we're going to use blockchain to support our clients and complement our existing business, both private, public, and broader crypto.
Raghu Rajan. I'm a professor at the University of Chicago Booth School. I was the governor of India's central bank, and before that, chief economist at the International Monetary Fund. And I'm here partly because I'm on RLUSD's advisory board, and I represent the central bank view to some extent.
Okay, excellent. Before we get to the regulatory side of things, I'd like to ask Sam and Scott if you could tell us a little bit about how you're using digital assets today, and maybe what's changed over the past 12 months.
Sure, absolutely. So I think what's really changed is the regulatory adoption and really the regulatory acceleration. I'm sure that you've heard that on panels yesterday. I think the panel before this was already talking about market infrastructure. So on the investment management side, we really see a flywheel effect occurring here. First with the Genius Act, where we're going to get stablecoins, regulated stablecoins on chain, which I think will have this sort of accelerated effect of investors really wanting to transact on chain. I would note that the Genius Act was a first step. Now we have to see the other regulators actually promulgate rules. And so we're really looking at sort of mid-2026 when we actually get the full regulatory clarity on what it means to have a stablecoin on chain and what are all the bells and whistles that come with that. And then in 2027, that's when we're going to see regulated stablecoins really come onto the marketplace, and we'll see, I think, particularly State Street's sort of investor base really become more comfortable, because then we'll have regulatory clarity and we'll have regulatory certainty. So I think that's one of the major drivers of a larger institutions coming on chain. And then, as the other panel was talking about, market infrastructure is another key piece that's going to unlock more comfort on the investor management side, really being able to issue additional tokens on chain. I think we sort of see this evolution as first tokenized funds, then we'll see tokenized equities in partnership with what the DTCC is looking at and how they're looking at digital assets. And then potentially further down the line, we'll see things like tokenized money, tokenized cash flows and other things like that. So really excited about the composability aspects of digital assets and what that does to the asset management industry.
Thanks, sir. So I guess just to position it, this is very much, I guess, my perspective from sitting in the markets business, and there's a lot of different businesses under the JP Morgan umbrella. So if you think about Chase, you think about asset wealth management and some of the other components, like everyone's got a different view of what's next. But I think everyone across the franchise is probably in a position this year where we feel a lot more freedom to explore what the potential is. What does that mean within markets? I think for a few years, we've been working on trying to understand how we can utilize our own private blockchain, because that's really the space we've had to operate in, to generate value for our clients and sort of create some opportunities around liquidity transformation from overnight to intraday, thinking about how issuances might work. And that's been really helpful in a couple of dimensions. One, on the practical side, to make sure we understood what does sort of DVP, atomic settlement, really look like on blockchain, sort of in a environment we know. What are some of the legals that we need to think about? How does that structure work? But with a lens of then being able to extend that into a more open architecture and public blockchain over time. So we've really got the private blockchain stuff we've been doing for a while. We've been involved in the cash settle side of crypto for a while. We're extending our footprint there. We've got a reasonable sort of base of activity on that side, and we'll continue to explore like how far that we can go down that side, and we can talk about more of that if you want. And then in between, I think that the new opportunity that we've been able to really look at this year is, if you think about what the opportunity set for public blockchain is, and Adina mentioned it yesterday about sort of pipes and plumbing and so on, there's some real opportunities there, but there is also, I think a rare opportunity to really think about, is there a way to extend the depth and breadth of capital markets? Because what capital markets are really meant to do is mobilize capital and liquidity across the real economy serviced by the financial services. And if there's ways that we can take some of that friction out and maybe bring new products to market and extend that umbrella, that's really positive for the actual economy and drives growth. So it's something we'd like to explore. I think there's some real potential there. It doesn't mean everything move that way, but there's some real potential there. And the other side of it is just from a cost perspective, we need to ask ourselves the question, and I certainly ask myself the question, is like, if I can use technology rather than run technology, is that a better outcome? Do we get to a point, if we can cross the risk threshold, which is a big if, by the way, of using public blockchain in a more extended way, is that better than running our own technology, managing that, having the data centers, et cetera? So there's a question there that we'd like to explore. I think there's a lot to work on both, but it's good to have the breathing room to do that now. We've gone from a restricted to a more permissive environment. And I think you'll see more products come to market as a result of that sort of freedom.
So this all sounds very conceptual and experimental, but I'm wondering if you can speak to what might be in production today and how you're using blockchain technology.
So I can start. So we actually did a partnership with JP Morgan, where JP Morgan issued a corporate paper on the Connexus blockchain, and then State Street Investment Management was the purchaser of that on their Connexus blockchain.
We underwrote it. OCBC was the issuer.
Yep.
No, it wasn't our paper. Just
sorry. Yeah, OCBC was, and you facilitated that.
Right.
And then State Street Investment Management purchased it on Connexus blockchain. And I think that was really a kind of a cornerstone where you had a third-party custodian come in, and then a third-party purchaser come into and operate on your blockchain. So I think that was a great proof point of the technology's promise. And then to sort of further see that accelerate is definitely something that we're looking towards. On the IM side, we also sort of think about it in two ways. One is we want to bring crypto and digital asset industry exposure to our traditional customer base, and that's largely through ETFs. So we have HECO, DECO, TechX that are vehicles that allow our traditional customer base to get some sort of exposure to the digital asset industry. So that's on one side. On the other side, we're looking at tokenizing some of our funds in order to be able to reach a new investor base, or that is the wallet-enabled investor. And there, we're still working on that. I think we'll have some exciting announcements coming soon. And that's really a different way to use the technology to reach a different type of investor that is now starting to move on chain. I think it's still early days, very much early days. And we get a lot of inquiries about interest in digital assets and how to operate on blockchains. But we certainly think that that's where the market is going.
I think, Sam's point about that partnership, I think is a really key one about what the next phase looks like. So we've done that on the digital debt service. I think it's natural extensions to bring more components to that. And we are now working on a project where we should see some of that CP issuance on public blockchain settled by stablecoin, digital custodian this year. We're working with partners to get that done because we really do want to pressure test that. Like what does a wholesale flow of a stablecoin look like? How do you mint and redeem that very, very quickly? What's the process? And for each one to be able to do that in the timeline that clients need and with the liquidity treatment that we expect. So there's some work to be done there, and that's an active project we're working on. But also on the liquidity side, when liquidity transformation, and we've used our own blockchain for a long time on this intraday repo product. We put a couple of $1 trillion through that in production, which is a pretty small number for repo, but a decent number for sort of blockchain trading sort of in a regulated way. And I think that's already extended to a wider set of participants. So we've partnered with a company called HQLX and Onera, or two companies that have enabled us to take collateral from a different type of technology, a distributed ledger technology interface, Ethereum compatible technology, and orchestrate settlement across those two things, securities in one and cash on the other. And we're now actively working to extend that further to have some trading venues, be able to provide liquidity screens where we can go and trade intraday repo, and we can add other cash sources, including stablecoins. So we're exploring the role of USD in that and see how we can then, again, extend from purely private into a wider set of connected blockchains, inclusive of public blockchain activity. There's a lot to do. There's around legals and regulatory side, but we can see a view of getting that done in quarters. So there's that partnership and I think collaboration across the market is starting to be realized. We can compete when it's mature, but for right now we need to collaborate.
Okay. Raghu, I want to throw it to you. We've been talking a lot about policy and the regulatory environment, specifically from a US lens, but I want to zoom out a little bit and ask you how governments and central banks are getting involved, where they see their part in this conversation, and really what risks they're trying to deal with.
Absolutely. Well, first a comment. I was at Swell maybe 6 years ago in Singapore, and I see a lot more suits on the stage this time around. I don't know if that's a good thing or a bad thing. But I think it reflects the greater formalization of the whole process. And I think if crypto is really to branch out, it has to integrate with the rest of the system. And that's where the central bankers come in. Because while it was a small play on its own, they sort of looked away and hoped it would go away. And it's not gone away. And as we talked about yesterday, there's so many opportunities to bring faster settlement, better use of collateral, more liquidity, more returns for people who have assets through these kinds of technologies. So I think they're starting to see, okay, we need to deal with this, and it's going to be integrated with our formal systems. Now, clearly, the first point they worry about is their own business. Fiat currencies. Is this going to replace it? For some central banks, it will. We talked about central banks in countries which don't have good macro stability, volatile currencies. Stable coins are already becoming an alternative there. So that's certainly part of their business which is threatened. But also payments. What they worry very much about is the payment system be fully secure. If for a day you start worrying about payments, I mean, think of the kind of disruption there would be in the economy if that happens. So they're very worried about the integrity of the system, of allowing entities to join in whose integrity is not wholly sort of secure. And they worry about new technology, which they don't understand. A lot of concern for a long time about forking. Is that going to be a big issue? And it's still an issue with some of them. So essentially, they're sort of trying to catch up. They would love it if this was really small, and they could continue with sandbox experiments and hope that everything gets resolved there. But it's not. It's big. And that's why the interconnections become so much more important. The first sort of reaction is to impose such strong regulations that there is no interconnection. Capital charges for doing this or for doing that on the banks are so high on some activities that you won't start. Now, you got to talk to them and say, look, there's no point legislating this out of action. You do need to engage with, and this could reduce risk. That's the big sell. This is going to reduce risk in your system. Why don't you try it? My sense is the easiest sort of attack point here are central banks of small open economies, Singapore, Hong Kong. If you increase the size a little bit, the UK. The idea being these are countries that have large financial systems that see the writing on the wall and want to create a stronger financial industry which benefits from digitization in a big way. And I think these could be the sort of Trojan horse, which sort of gets into the banking system. That said, central bankers are sort of exploring in a strong way. The BIS in Basel is where they congregate, where they talk about all this. I think the United States can play a very positive role in encouraging this process. What is important is dialogue with some of the other big players, China, for example, and so on.
Got it. We were talking backstage a little bit about how all these different rules fit together. Scott, you had a take on this. I'd love to have you bring it to the stage about, how regulations in the U.S. are kind of setting the stage for what other countries might follow.
Yeah, I think the tone here has been really helpful sort of globally. I think there's been a lot of there's been a change in the demeanor, I think, in a bunch of different countries around like, hey, well, we'll see where we can take this to, let's see how fast we can follow the United States, which is great because it kind of means that there's at least some sort of harmonization of the thought process, which is good. But it then does become contingent on the United States actually moving. And then there's also like, once that happens, what existing regulation exists? Like we talk a lot about, these new regulations is really helpful. We can do all these things, but actually there's a whole bunch of like rules out there already that actually will bump into this. And just because there's a new regulation doesn't mean the old one doesn't matter anymore. And we've seen a few examples of this in Europe, where there's specific regulations that sort of buried 3 levels below what you would normally expect. And even though there's MiCA and the pilot regime and e-securities law in Germany, there's some challenges doing stuff in Germany with e-securities when we move collateral. Like that still exists. You can't get around that. Even when we get to the point where there's more capability for banks to be involved in crypto in a like actual sort of spot and trading rather than sort of cash settle side, the Federal Reserve Act prevents commodities being traded by bank held broker dealers offshore. That's a law. It's not going to change. So either it's not a commodity, which that's not going to be reclassified, or we need to get exemption to be able to do that. So there's a bunch of existing things that even though there's great freedom and opportunity coming, it still has to be worked through the existing regulations. So that I think is one of those things that naturally sort of extends the time horizon of the growth opportunity beyond sort of quarters into sort of years, I guess. Not lots of years, but certainly longer than we would expect, because that does take a thoughtful change by a regulator. Because if you change the rule for one specific thing, thinking through the second and third order effects of that actually does matter. So crafting that appropriately, having it thoughtfully tested in a way is important. So there's some nuance there that, even though I agree with you, like there's some really good stuff coming and United States is leading it, we do we do have a very deep book of rules that we need to follow already. I don't know, Sam, if you've got other things.
Yeah, no, I absolutely agree. And I think when we talk about tokenization more generally, there are a number of different rules around the US capital markets that really bring that investor trust. And so, things like Reg NMS, the national market system that allows for consolidated pricing about buy orders from different broker dealers. How does that work in a decentralized fashion when you're using an automated market maker that's really a mechanically deterministic way to do pricing? If you're, how does the role of the broker dealer potentially change in terms of suitability and price discovery if the broker dealer is not necessarily in the in the chain of investment? I think there's a number of other outstanding things about tokenization in terms of what you see, some of the pilots that are being done right now in terms of using SPV vehicles to issue a token for an otherwise listed equity or fund. And if one institution tokenizes a existing ETF, and then another industry, another corporation issues another version of that tokenized asset, are they fungible? I don't think that they would be. And then you need to talk about what are the prospectus and the disclosures that go with those different types of tokenized entities. And do we really want that? Do we want to have 15 different versions of tokenized SPY? And does that sort of complicate the marketplace and make that a deterrent for the investor to really understand what they're getting when they're investing in something like a tokenized entity? So I think there's still some rules to be figured out. That some of that will come with the market infrastructure bill, and then some of the rules that will be promulgated by the SEC once the Infrastructure Act is passed. And these are not small items, right? I think the market has spent the last 60 years or so trying to move away, for instance, from bearer assets. And we have registered assets that are in the DTC's depository. And now when you're talking about DeFi and some of the promise of tokenization, you're almost trying to look at maybe potentially going back to types of bearer assets, and what are the risk profile associated with having bearer assets, and how does the investor get protected in that scenario? So those are some of the themes that I think are still yet to be figured out. It's not going to be in the next 6 months. We're looking for market infrastructure legislation, hopefully in the next 12 months or so. And then there will be another sort of 12 months after that for the actual regulatory agencies to implement those rules and clarify different things that might not be fully applicable to DeFi.
Got it. Raghu, you had mentioned earlier about how some of these governments had seen the crypto industry as being separate from, the broader traditional financial industry. I'm wondering what State Street, JP Morgan can do in terms of getting them comfortable with some of these innovations that we're talking about.
Well, I think the fact that they're engaged itself is very positive, right? It sort of adds a certain amount of respectability, and their entire sort of experience of regulation and compliance and so on is brought to the table. I do think there is a process by which the crypto industry moves ahead, and then there's a catch up, but it doesn't move too far ahead. One of the worries is there's a big event, which then SARs the whole political establishment on this, and then things go back 5 years, 10 years. Now, remember, the US is probably in the forefront of experimentation, the willingness to allow this kind of free-for-all. Other countries are not so forgiving. Something like an FTX in another country would have meant the death of crypto for a long time in that particular country. They're far more worried about downside risk, while in the US, there's far more of an appreciation of upside risk. And so willingness to take some of that risk because of the value. So what I would say is what we do need to do is learn what needs to change, and then periodically get an omnibus bill which sort of deals with those changes. But be careful about moving too fast, too quickly. Let's get the experience, move ahead some more. And I think that's how you get the integration, not just in the US, but across the world.
But the other thing I would add to that is that, everybody talks about regulatory clarity, and that's just the first part. The second is legal certainty. And in order for us to really be able to issue tokenized versions of our funds and make those available on chain, we need legal certainty. And that really comes with the promulgation of rules from all of these different agencies. And I think, you mentioned legals is a big part of this. There's a lot of questions about that when you have a tokenized version. What is the rights of the investor, and how does the investor feel confident that they know what they're getting when they're purchasing these things on chain?
And it's different in wholesale. Like I think it's great that at least we've got an environment now. Personally, I think it's great we've got an environment now where we can have a bit more open innovation that actually forces the argument for the broader financial sector to ask itself the question. Whereas previously, like that wasn't even really an opportunity to ask ourselves a question like how far can we go and how far should we go? Now we can at least have that conversation. We come up with our own risk appetite and sort of push into the area we think supports the clients in a way we think is the right way to do that. But it's really different. If you've got a retail franchise, and like, I don't know about you guys, but like if I log on to a, Kraken application and I've got to accept the terms and conditions, like a tick, yep, don't even read them. Like at least what I should do is download them onto ChatGPT and say, are these okay? Should I, but I don't even do that. I just go tick. Like, if JP Morgan sort of goes into a trade with a counterpart under any structure, we read everything. Our counterparts read everything. Our lawyers and their lawyers then argue about this stuff for ages about like why in this particular, and that's really good, by the way, because the underlying LPs that are doing this, like you and me, have got money in our 401ks or some sort of fund that you invested in, that if we don't do that, you lose it. So it's really important that conversation happens and happens in detail. And so I think, having that two gears of like, let's pull ahead and innovate to a point where we get to see some like new opportunities in how capital markets will work, but also having sort of like the break of the reality of what it takes to get things done in the wholesale markets will hopefully balance out where we get to a good space where you get that change, but you get it done in a way where, to reconcile, like, if Mr. and Mrs. Brown in the middle of America like lose all their money because there's been some crisis in related to digital assets markets, is their congressman or senator going to vote for the next bill that says, yeah, like I'll support that? Like that's the sort of the way we need to think about this and getting it the right balance with the right amount of protection, with the right amount of innovation. And I think we're getting there. Like there's work to do, but it does feel like it's starting to evolve that way. I certainly hope so.
And I think in 2024, a lot of the discussion was about private chains and consortium chains, and it was really limited to that. And now with the change of administration, it's not like we're talking about private, public, and of course consortium chains. We're talking about the value of the actual blockchain. We're talking about how the consensus mechanism works. Do we have faith in the consensus mechanism? Does the node validators and the dispersion, does that offer different value propositions in terms of resiliency and speed and cost? So we're really changing more to looking at the actual features of being able to issue on different blockchains rather than talking in sort of the more high level, is public really safe versus private? And does it need to be such a binary in the conversation?
Which also goes to the regulatory side, right? Once they have a better understanding, trying to differentiate between the resilience of different kinds of blockchains and according different risk weights to them and so on is going to be part of the answer driving us to a safer system to some extent. So they will get into the act. Right now it's sort of all blockchains look equal. They're either permissioned or not, but permissionless, but we sort of treat them in two buckets as opposed to many buckets within each one of those. And that, I think, that comes with learning. And so engaging with the regulators, trying to tell them what is going on, and they will learn, and I think they will differentiate.
And I think you made a point around the 1250 surcharge, right? And that's not really, it's cost prohibitive in a lot of ways for really any kind of financial services to come into that space. So I think, we're watching the Basel Committee. I think they indicated that they would be open to reviewing that guidance, and maybe it shouldn't just be 1250, it should be risk-based, just like much of their other guidance. And so I think we're seeing encouraging signals at sort of the global level as well. Now, whether each of the different jurisdictions adopts those rules in a different way is another question. But I think, again, more promising signals for seeing real, true, large institutional interests coming onto these different blockchains and embracing tokenization.
When you talk about the global picture and how different jurisdictions are viewing this. How important is some degree of harmonization? I mean, I think it's pretty clear it's going to be hard to get there, but how do you think about the amount of sameness across the globe that you need to actually operate?
I think just enough sameness would be good. And by that, I mean, like if everything's vanilla globally, then there's no market opportunity to innovate and extend and compete and drive like an outcome that's one capital markets starts to develop in a way that sort of is a model for others. So, but if you're too separate, then actually you get concentration in one market or another, and you don't get some of that broader capital markets value of global capital and global liquidity to generate growth across both within and beyond across economies. So having just enough that you can make some sensible decisions about where to invest, having just enough harmonization where you can get reasonable treatment for your clients in that jurisdiction to really like operate in that jurisdiction. But for us as a wholesale business, most of our clients do global things. So there needs to be that sort of relative certainty. But if it's all the same, like no innovation, no competition to drive that further. So I think I personally don't want to see exactly the same rules everywhere. I don't think that's a great outcome either.
It may also be that in some products, having differentiated sort of rules can actually help. So think of, for example, one of the big concerns is weaponization of payments, right? That's what a lot of other countries are worried about. Well, if you have a US dollar stable coin and all the reserves are in the US, it certainly helps to have a common, it's efficient. But other countries are worried that it's all in the US. They would rather that it's a US dollar stable coin with reserves in Europe or reserves in India, so that in a sense, they have some control over it. It's not completely at the mercy of US authorities. So fragmentation there can be helpful in reducing sort of political concerns. Now, which way do you go? You want sort of efficiency, but you also want to make inroads into other markets where there's a concern about using sort of US assets. Those are the kinds of debates we will have going forward, given the world we live in.
And I would add to the stable coin, stable coins are global in nature. They're available everywhere. The question is then, is a stable coin have to be licensed in each of the jurisdictions in order for that investor to be able to use that as a form of payment to subscribe and redeem into our types of funds? Or is it that it's licensed in one particular jurisdiction and that's enough for any investor to be able to use that stable coin if you're subscribing and redeeming into a, for instance, US domiciled fund? So I think there's a lot of still outstanding questions about sort of the global nature of digital assets and how that fits into.
All righty, what is going on, everybody? Welcome back to another live stream. I don't have too much more time today, so we're going to pick one more stream on the Ripple Swell video breakdowns that just went live. That's kind of what we're dabbling into as of right now. As always, all of this research can be found inside the private CyberX Discord. I told you guys that throughout the week moving forward and then heading into 2026, myself or Aqua will be streaming some of the content that is within inside the private CyberX Discord and the research channel, so that way you guys can get a peek into how much information is within inside the Discord. So we're going to tap into one more. The one that we were just watching was the maturity and digital asset adoption video here. And all these panel discussions from the Ripple Swell that just launched publicly, so that you guys can go back and watch all these. This is obviously, of course, a conference that took place earlier on this year. I'm thinking about doing unlocking the future of prime brokerage and clearing with Ripple, or institutional custody and tokenization with financial institutions. Which one of these two do you guys want? You want institutional custody or unlocking the future of prime brokerage? Let me see in the chat, you guys. One or two. One or two. All righty, we're going to go with one. Dang, you guys said two. All right, let's go with two then. Institutional custody and tokenization with financial institutions.
Thank you for joining this afternoon. So I think we can all agree the conversation around digital assets has fundamentally shifted. We're no longer debating if institutions are going to adopt this technology, but the real questions are how fast and with what infrastructure. And when you think about tokenization, we've really seen this really move from theory to reality over the last couple of years, with a big wave of institutional adoption. I think the market cap sits at about 35 billion, maybe just shy of that if you eliminate the stablecoin volume. But frankly, I feel like we're only just scratching the surface of what's possible here. And I am honored to be hosting this panel with 3 industry leaders who are not just sitting there waiting for the change, they are actively leading from the front and making it happen. So I'll just hand over for each of the panelists just to give a quick introduction. Ryan, why don't you kick us off?
Thank you. Ryan Rugg, Global Head of Digital Assets for Citi's TTS business. Been with this organization for 3 years, but been in and around this space for a decade now, so have seen multiple ebbs and flows. Prior to that, worked for IBM. I ran their blockchain practice for Americas, and then prior to that, worked for a fintech startup for 5 years. So looking forward to this conversation. Thanks for having me.
Thank you.
Thank you. Sandy Call, Head of Innovation at Franklin Templeton. We really think about the entire ecosystem, from the thought leadership about where it's headed to building the technology and creating the products to deliver on it. Our digital assets team is part of our innovation unit. And prior to that, I was at Citi, where I did the thought leadership for many, many years, and actually wrote my first big report on this space in 2017. With the title of that report being "Tokenization Will Replace Equities and Bonds Over Time." And people thought I was crazy.
Hi, everyone. Cynthia Lobissette. I run the digital asset management division at Fidelity. We at Fidelity have been working in the digital asset space, starting with research early on over a decade ago. And I started myself almost coming up on 6.5 years. So as we talk about, 1 year in crypto is like 7 years in TradFi, I'm almost on my first dog year in crypto. The digital asset management division sits within the asset management part of Fidelity. We do have a few different units within and across Fidelity. We do work quite closely together, looking at all of the different applications where this technology and where these new assets are going to change the way in which we deliver financial services and solutions to our customers. Our custody business is the custodian for the ETPs that we launched. We do work closely with the custodian as we are also evaluating other offerings. And we also have the Center for Applied Technology, which really is where the early research and development in this ecosystem started at Fidelity about over 10 years now. And they do a lot of early R&D work, hands-on with the technology, running nodes, mining, all across the ecosystem, and do a lot of great research that adds to how we think about the ecosystem as we are researching protocols and the assets themselves.
Wonderful. Thank you. So it really feels like tokenization is moving into the mainstream. And I've heard it a couple of times today as well, but comments like everything will be tokenized. So first, I just want to get your opinions on whether you think that will be the case in financial services. Is there a need? And then secondly, from where you sit, what are the most compelling use cases that you see that either you've perhaps already launched or are looking to launch in the future? Ryan, why don't you kick us off?
So I think back to 2015, 16 when I started, and we tokenized everything under the sun: equity, bond, IP. But we always had to go back to the TradFi rails to settle. So when I joined Citi, if we can't tokenize fiat, which is arguably one of the most simplistic assets, how are we going to start tokenizing other assets? So that's where I started on the journey at Citi, is really being able to tokenize deposits in this case for our large multinationals. So the pain point that we're trying to solve is, we're in 90 plus countries, have 19,000 clients that, move money around the globe, daily, hourly. but they have to forecast for, market cutoffs, banking hours, weekends. How do we remove that, latent liquidity from the system? So what we rolled out last September was, City Token Service. We launched it in our largest money hubs. So roughly now we have, 85% of our USD flows between the US, UK, Hong Kong, and Singapore, where now clients can move money, weekends, holidays. So if it's 5 p.m. in New York on Friday, it's 5 a.m. in Singapore. Typically, our large treasurers would have to kind of pre-fund their accounts in Singapore. So really focused on that. So I think, as we start to scale this and move into other tokenized assets, but like this way, removing that friction with the fiat world.
So it's an interesting question, right? I do believe that everything will eventually be tokenized, but the reason that it's going to all eventually be tokenized is actually more foundational, right? Because we have been in a world where we all have tons of accounts, right? You have a checking account, a savings account, a brokerage account, an insurance account, a healthcare savings account, a 401k account, right? You have a million accounts. That world is going to disappear, right? We're going to move into a world where everything becomes centralized in a wallet, a cryptographically protected wallet where all of our assets are going to be aggregated. And this is why they need to be tokenized, right? So that they can sit in the wallet and we can start to optimize and have that aggregation, not just an aggregated view, which is all we're capable of doing today, even with all the technology that exists. We just aggregate the view across all of our different accounts. We're going to actually have real aggregation, and these assets will sit side by side and be interoperable. And this opens up tremendous new opportunities for how to use those assets, how to create passive income from those assets, how to create active income from those assets. So it's an exciting new vision. But to Ryan's point, unless we can pay for things, we can't get to that vision. And so I do think that from Franklin Templeton's perspective, paying for things is, our job as an asset manager in this cash management layer, which is being able to manage the tokenized money market funds. So Franklin Templeton was the first firm to tokenize a money market fund. We did this back in April of 2021. And we have been running that fund 24 hours a day, 7 days a week, 365 days for 4.5 years now. So very exciting. We have expanded the blockchain-based system we built to run our funds on. We're now across 9 different blockchains. We interoperate across all 9 of those blockchains, public blockchains and 1 private blockchain, so 10 chains in all. Like Cynthia and the team, we believe you can't operate in this system if you are not part of the network. So we also run our own node operations. We do our own trade verification. And we're running our own patented wallet system, which has enabled us to create new types of functionality that never existed before. And we are actually running our product as digitally native on chain, and that allows us to settle in real time. So I'll talk more about what we do, but just to give you a sense, I think it's the wallet that's so key. And what we're doing is we're building into a future wallet-based ecosystem.
So maybe to add on to what Sandy's already outlined in terms of the wallet as a critical piece of infrastructure, which allows you access into being able to use tokenized assets. As we think about what the financial ecosystem, how it operates today is through a fiat system, and that fiat system runs through traditional banks and bank operating hours. And what we are really excited about in being able to move assets on chain is a combination of access to be able to trade certain assets, not magic liquidity. We'll get to that, I'm sure, later in the conversation. But being able to trade assets on a uniform platform that allows you to be able to have that interoperability. And I would say, in the early days of tokenization from 5-6 years ago, when some of the early proofs of concept came to market, that was really about demonstrating that you can represent that asset on a ledger and be able to transfer that asset. There weren't that many people to transfer the asset to, and the infrastructure really wasn't there. But one critical piece of infrastructure that really was not there is stable coins. And stable coins are that operating rail that represents the way that fiat allows for transfer of assets in our traditional markets today. And so now when we see that there is the Genius Act that is ushering in more diversity for this ecosystem to be able to represent cash on chain, you need that liquidity layer in order to be able to have assets that are tokenized to be able to grow into a more robust market. So you need not just the critical infrastructure to allow investors to get access to these assets, but you also need the liquidity and you need that market to be able to evolve such that people can trade. So not just hold the assets, but trade and then ultimately use the assets. So this mobility is also a key element for why it is that we are so excited from a asset management standpoint in allowing our investors to be able to construct portfolios on chain with a wider variety of assets to get to that level of hyper personalization, not just in your exposure, but your own personal liquidity management. And that is incredibly powerful when you think about your ability to control in that single account, how it is that you can think about short-term, medium-term, and then longer-term liquidity.
Absolutely. I think we're observing that in the market. Tokenization and stable coins kind of go hand in hand, and it really does solve for those some of those early issues there. Sandy, you mentioned you launched the first tokenized money market funds on chain, so phenomenal work in 2021. Love that. But considering the inherent complexity of kind of large global financial institutions, I'd love to understand how you're developing infrastructure with a 75-year-old business with building for a tokenized future. Kind of how are you navigating that?
Hey, we're the baby up here. These guys are kind of older. Yeah, we really have been lucky in that our CEO has had a lot of vision, and she really views her job as multi-generational, right? She's the third generation of her family that's running our company. She has a very strong sense that she needs to leave this company well-positioned for the fourth and the fifth generation. And so she was very early, as was Abby Johnson, in thinking about these technologies. And so we've really run digital assets. You can almost think of it as a startup within our broader asset manager. And we built these technologies ourselves. We have gone and worked hand in hand with the regulators. We launched early and we worked with the SEC here in the US. We developed our own proprietary wallet solution that is KYC AML enabled. And what we realized very quickly is that this is a global market, right? You can't just operate in the US. And so our journey since launching the first fund has been about expanding into other geographies. So that requires different regulatory wrappers, right? So we have tokenized now a UCITS fund wrapper so that we can access all the UCITS eligible markets. We have tokenized a private fund wrapper, which we are working with big institutional traders on to use in their collateral use cases. And very excitingly, we have tokenized a variable company, a VCC structure, which is the new structure that has come out of Singapore. And we are actually partnering with Ripple and with DBS in that marketplace to use that retail-focused tokenized money market fund that has a variable rate. It's not a fixed dollar rate product, but we're able to use that, and we're going to be able to offer that as collateral and as a savings vehicle through DBS in their local exchange to those local Singaporean clients as well. So we're very excited about how we've been able to expand the product set around the world. And that has given us the experience now to have the platform on which we're going to be now extending into all sorts of assets, right? We're going to be bringing really our full suite of what we trade as an asset manager on chain. And that's going to bring this idea of the personalized portfolio, the hyper personalization that Cynthia was talking about, into the wallet, into people's everyday lives. So it's such an exciting time to be working on this. And we're very fortunate to have great partners that are working with us.
Awesome. I speak on behalf of Ripple. We're extremely excited in partnership with yourselves and DBS there. Ryan, Citigroup, one of the top 4 US banks, always keen to understand how the approach you take when it comes to building infrastructure. Are you looking at, do you build, do you partner? What's been your kind of route to market there?
Yeah, it's been like all three, right? Build, buy, partner. And I think about what City Token Service is, and that's kind of building out that foundation. And a lot of what you said, resonated. Like City's been around, as you said, 200 plus years. You're the baby on stage. Where like, how do we continue to innovate? How do we continue to drive change? And I still host daily stand-ups. I brought a lot of kind of like what I did from the startup world into City, where I have legal, compliance, risk, all the reg team, all of them on, like, what's in your epic? What sprint are you releasing? Are there any issues? Like really bringing that kind of approach, because it does take a village to move, with a highly regulated institution to move the needle and create new products, but doing it in a safe and sound way. There's a reason we've been around for 200 years, and there's a reason that clients trust us. And we just view this as a new set of rails and a new asset class that, as our large enterprises and corporates want to enter into this space, that we're going to service. But you have to take an innovative approach. So like that's in the build. The partner, like we fully recognize that this space has been around for quite some time. There's amazing technologies out there. There's amazing companies out there that we're going to partner with. An example is last week we announced our partnership with Coinbase, right? Being able to give our clients exposure. So bridging the gap between TradFi and DeFi, where, if our large, corporate clients, enterprises want to have the on-off ramps, we've partnered with Coinbase to be able to do that. And then we also invest. There's several investments out there. Recently, we announced BVNK. We continue to invest in this space as well. So, the way that we've approached it for a holistic strategy, we have to be hitting all three cylinders to truly be successful.
I think we've certainly seen that, the convergence and partnerships to provide that quicker route to market, and maybe the infrastructure to be able to get that first step into the space. Cynthia, keen to come to you as one of the Fidelity, largest, most well-known kind of diversified financial services firms globally, serving millions of investors. I'm keen to understand, how does tokenizing assets on a blockchain differ from managing them in the traditional environment? Certainly as it relates to settlement. You mentioned earlier liquidity. So keen to dig in there a little bit more.
So a couple of things around infrastructure. When we started building out the digital asset management business, now it's about almost exactly 3 years ago, we looked at it holistically from really two angles. One was this new emerging asset class. How do we give our investors and our clients across our platform access to this new interesting asset class? And delivering this asset in a traditional wrapper was a way to get sort of mass access to investors across the brokerage platform, and simplified our investors' ability to be able to get access to on-chain assets. And so we think about this path to the adoption of digital markets, through this lens of hold, views, and build. And so hold was bringing on-chain assets into a traditional wrapper to allow broad market access to these assets. That required some additional development across our back offices. So being able to use traditional back office accounting and administration services with these adjustments. And so while the asset was a single spot asset sitting in a traditional wrapper, there were some accounting issues. We talked about decimal place differences. For Bitcoin, which is 100,000 plus, if you only had 4 decimal places on Bitcoin, I think it's a little bit more than a rounding error. So, so those are some of the things that we worked on to be able to add the enhancements. When you want those assets to be usable on chain, and this is now you've got either traditional assets that sit in an on-chain wrapper, which is the tokenized money market fund that we also launched about 2 months ago. There are some additional things that you need to think about from an infrastructure standpoint in terms of how do you enable this asset that is a traditional fund share to now be represented on chain. And not only is it represented on chain, but it needs to have utility on chain. And that's where it becomes very, very interesting, where you've got a mismatch with your traditional back office infrastructure that runs on batch cycles, whereas these assets are transferable all hours of the day and night. And so there is additional development that needs to be done in order to be able to support these on-chain assets. And we can keep going, where you now have these crypto assets that can be staked, and there are new transaction types and functions that these assets now are capable of to generate yield natively on chain. Our traditional systems are not set up to be able to support that entire life cycle, and so additional development there is necessary as well.
Brilliant. Great to hear. So let's switch gears a little bit. I'm keen to.
Did y'all just hear the lady from Fidelity confirm that they're upgrading their infrastructure in order to participate in staking and yield generation in crypto? I'm pretty sure that's what she just confirmed in a nutshell, to kind of put things into perspective. That is pretty insane that Fidelity just said that on stage. So take that into consideration as we almost are about to wrap up this particular video breakdown.
Hear about the demand you're seeing. You're all building, for a tokenized future. Is it a build it and they will come? And I'm sure, as we've mentioned, it's moving to the mainstream. The volume is picking up. But are you seeing clear demand already from your customer base? And then has it allowed you to, extend users? Have you been able to gain new customers who maybe are looking at, your institutions as the innovators, and as a result, you're gaining new business that way? Ryan, why don't you kick us off?
Yeah, so, I think back to the early days of CTS when we first launched, well, 3 years, but I guess that's early days, to like where we are now. And, we're close to 100 clients and now processing billions, which in city terms is like nothing, right? I mean, we process 4 or 5 trillion a day. So we're just starting to really scratch the surface on it. But what's exciting is that's really started to shift is like last year, I feel like, we were pitching clients, explaining the technology, explaining why they should use it. And we've completely obfuscated the complexity of a blockchain, and that was by design. So our clients log on either via an API or Citi Direct with a UI to be able to access Citi Token Service. And it's just a drop-down box. They wouldn't actually know they were using tokens if its name wasn't Citi Token Service. But, we'll mint the token in New York, we'll send it to Singapore, we'll burn it. So for cash or fiat for fiat, it's synonymous to what they know. So there's no, and that was feedback from clients. There's no addition operational, there's no additional accounting, there's no additional, like they don't even have to open a new account. Like they basically let their salesperson know and we enable it in the background. And that was all by design because you need to meet the enterprises where they are in their journey. But even with that, like adoption initially was a little bit slow. Where I think now people are the whole real-time economy, making money kind of match the speed of the internet is like becoming more of a realization, like that's the way we're coming, this digital economy, and how do we start to adopt this technology? So I'd say like, adoption is definitely starting to uptick on it, but we're just beginning on our journey.
Of course, customers start to see the benefit. So there's a bit of a tipping point that you see there. Sandy?
Yeah, so right now I call it a two-way street, right? So in our digitally native part of the business, right, where we've launched the tokenized money market fund, we have opened up an entirely new set of customers, right? We're working with the treasuries of the different foundations that are launching the blockchains. We're working in the reserves of the stablecoin providers. We're working with the derivatives exchanges to be able to post collateral for stable coins, because you can get better haircuts and better rates if you're posting with a tokenized money market fund versus a stable coin. So we're mirroring collateral there. And we've really been able to get into the institutional audience that is trading in the coins and the tokens and the derivatives of the crypto ecosystems. And that is a whole new audience. And for that audience, we have been making great strides. We've really been working in a digitally native way with them because we have had years to be building this technology. We do settle in real time. We do keep a real-time record of our register. We are a digitally native token, right? So we are able to do things that money markets have never been able to do. We're able to payout yield intraday. So if I hold my money market position for just a few hours of the day and I don't hold it at the close, today I don't get any of the interest in a traditional money market fund structure. But with our platform, to the point with Cynthia made around the extra decimal points, when you start working in these new technologies, there's new capabilities enabled. So we're actually able to calculate that share of the day's interest and apportion it perfectly to reflect the actual ownership record. So that's a whole new piece of functionality. Because we've built our wallet system and we have the KYC AML attached to our wallets, we're able to allow customers to transfer their tokens peer-to-peer, right? Again, this is not something that you can do with a traditional money market fund. So we've gotten great adoption. And now what we're doing is we're building product to help people who have a lot of crypto profits begin to diversify into traditional assets. And then on the other side of the street, we're taking the crypto products and we are creating exchange-traded funds and exchange-traded products and private funds for more aggressive investors, institutions. And we are bringing the crypto world into the still account-based structure to give them an ability to diversify their portfolios into the crypto world. So you've got crypto profits going in traditional assets. You've got traditional assets trying to get into some of the crypto profits. Other than today. And therefore, it's still kind of very much a two-way street.
Brilliant.
It is an exciting time to be an asset manager, I would say right now, where we have on-chain investors who are interested in not just the ability to have Fidelity manage a tokenized fund or a tokenized product for them, but they are also interested in our other investment capabilities. So similar to what Sandy talked about. And so when we think about how do we package these exposures, we now have new on-chain wrappers through which we can package our existing capabilities and find new audiences. We also, and I like to think of this a lot as the flow of capital between traditional markets and on-chain markets, is tokenization allows for capital and access to capital on-chain for traditional investors. So it opens up a new avenue for access to capital, which is something that we're really excited about. And this is, again, where partnering with other platforms where they have users who are interested in being able to get income on their stablecoin balances. And we have products that allow for that, creating that interoperability and now seeing new client bases and new demands that this technology allows that facilitation to connect.
Fantastic. So, let's look forward now. Okay, so 5 years from now, for tokenization real world assets to kind of really, get to where we kind of all believe and many people in this room think it's going to go, what needs to be addressed to truly, accelerate this market? I'll start with you, Gameway.
For us being a highly regulated institution, we do not operate in the gray area. So unless it's permissionable for us, everything that we've done with Citi Token Service, not only do we get regulatory approval here in the US, every branch we've launched. Yep. So HQMA, MSA, FCA, we get approval from all the jurisdictions. And this is an internal solution, right? This is only for KYC, AML, BSA, Citi approved clients. And we've still taken that approach because the language wasn't clear out there. So that's not going to change, as we start to, yes, everyone's like, well, Genius passed, but our regulators still have years to opine on this. Mm-hmm. And our tokens, big outstanding question for us, are tokens going to be treated like cash? When cash comes into the bank, we do all the checks and balances. But because of this technology, you can see 5, 10, 15 hops ago. If it was used in a sanctioned country or for illicit behavior, what does that mean for our clients, but also for us? So I think for true adoption and scalability, we need that regulatory clarity. Sure. Because from a technical standpoint, Citi Token Service is an ERC20 token. Mm-hmm. There's no reason from a technical standpoint. It's more from the regulatory approval and also, the safety and soundness that we can ensure. We're not going to go into something unless we can ensure that the safeguard of our clients' assets.
Absolutely. We're taking steps in the right direction regulatory-wise, but
we're moving.
Still may take a little bit of time. Sandy?
Yeah, I would say that, a lot of the things we can build fixes for, right? Cynthia's mentioned some things, Ryan's mentioned some things, hopefully we've mentioned some things. But, you know, there's certain things that we can't build our way out of. And one of them is the way that KYC AML works today in the industry, right? It doesn't matter that Ryan and Cynthia and I may have the same client and we may have complete confidence in all the documentation that we need to prove that that client is a safe counterparty. We cannot share each other's KYC AML, right? Each of us has to individually go in and do our own assessment and certify ourselves. That is a huge drag in a system that's trying to work in real time. So as far as we're concerned, one of the biggest areas that I think we really need to revisit in light of new technology and new abilities is how can we use ZK, zero knowledge proofs? How can we use soul-bound tokens? How can we use the fact that now everything is going to be concentrated in public address listed wallets? How can we use these new layers of transparency to be able to update the approach to identity and KYC AML? Because we really need to be able to share and have instantaneous KYC AML for this system to really achieve its potential.
I couldn't agree with that last part more. And if you extend the on-chain ID necessity in the nature of this market as being cross-border, but also these tokens are highly programmable. We have the technology. I think of this more as a people issue than it is a technology issue, is to get global regulators to agree to a standard or a programmable standard that you can then have self-custody of the individual identification information so that you don't have to share it with 16 different institutions if that's who you want to transact with. And then I think the flip side of on-chain identity is also, as we think about the transparent nature of blockchains and the transaction and data transfers that occur, privacy is also incredibly important. And they're very excited. I am very excited about the number of projects that we've seen over the last few years that are really focusing on trying to create the tools necessary in order to be able to protect the privacy of individuals who want to transact. And as a large institution, who does a lot of trading, this is something that we also have worked through in TradFi as to how is it that we can protect on-chain transaction information. So there is a need to be able to have that level of comfort and safety in how it is that you're going to be able to provide that financial transaction levels on chain.
Definitely. Got about 30 seconds left. So we'll end with some predictions. Okay, so there are some varying, I guess, predictions out there and where the market will be in 5 years as it relates to tokenization of real-world assets. Keen to hear your thoughts in a number, what the market cap will be in 5 years from now. And I would say, caveat, with regulation in place.
With regulation.
With regulation in place.
Today, we talk about tokenization in terms of billions, whereas traditional markets are in terms of trillions. I hope in less than 5 years, we're talking about trillions in tokenized assets on chain with real utility for those assets.
And I would like to add to that, I would love to see billions in brand new assets that have never existed before that we can now bring on chain because of tokenization, where the operational frictions of being able to administer them at scale, things like IP rights, things like sports team ownership, right? Things like this. I hope that we're able to have billions of brand new assets that never existed before.
Amen.
No, I agree. We talk in billions, but it's definitely, make a plug. We just wrote a, GBS Institute report with stable coins that our base case is trillions, like a couple trillion. I mean, once you start to see these enterprise adoption across the space, but as you said, there has to be clarity for some of us in this before it starts to scale.
Absolutely. Well, I think we'll leave it there. Ladies and gentlemen, please join me in.
You know what I just don't get Like, I mean, of course, we know they're all under NDAs and a bunch of stuff and regulatory restrictions. They can't say certain shit, but like, why they always got to beat around the bush like that? Like, my dude asked you a straight up question. Give me a prediction on what you think the market cap is going to be in 5 years. And none of them gave a straightforward answer. They were all just like, well, trillions. Nah, yo, like 20 trillion, 50 trillion, 100 trillion. We all know you want to say it. So just say it, right? Like, I don't know if you guys catch that feeling, but I know I sure do, which just gives me ever more confidence that seeing them smirk and hold back what they really want to say gives kind of a forward looking trajectory on where we're actually going. Nonetheless, hopefully you guys enjoyed this brief live stream. As always, giving you guys some of the realest information and research in the game. This is just some of the research that was shared recently inside the private CyberX Discord. As always, going over the panel discussions, the summits, the blockchain events that take place that nobody watches or goes over. Hundreds, if not thousands of them are shared inside our private CyberX Discord. All of the video breakdowns, the documents, the LinkedIn profiles that you guys should be paying attention to can be found in here. Head over to cyberxtrading.com. We'd love to have you guys and gals on the team. Happy New Year. Many blessings to all. This will probably be the last live stream before we head into the new year. In the evenings rolling into the new year during the week, we're probably going to be streaming these video breakdowns live, going over some of these panels, taking a look at some of the clips via some of the high-end organizations and panelists that set to take place on stage. As always, be cognizant to always go out there and do your own personal research. And I'll see you guys in the next video breakdown.